let me talk about the distinction between banking, the activity that we normally associate with banks, and e-money issuance, which is what mobile operators do when they issue e-money accounts, or PayPal does when it issues its electronic money accounts. These are accounts into which you can deposit money, you can withdraw money, you can pass it around and make payments. How are these different to banking? And in particular, why are regulators comfortable letting non-banks do what appears to be very much like banking? To look at all of this, first let's understand the activities of a bank, which we can represent through their balance sheet, which is typically fairly large and contains two sides. On the right-hand side, we put liabilities, which are the funding sources, where money comes from for the bank. It'll come from deposits, typically these will be shorter term, or it can come from shareholders, the capital that shareholders will expect back at some point. And with this money, it invests by giving out loans. This is the asset side of the balance sheet, which is the earning side of the balance sheet. As a customer, then I can deposit a little bit of money into my account, and now this is my sliver of their liabilities that has my name on it. This is money that they owe me. With this money, then they can then loan it out to someone else. They'll make money if the interest rate on the loan is higher than the interest rate they're paying me on the deposit, and if enough loans get repaid. How does this change when there's an e-money issuer involved? We can represent the e-money issuer as a separate player with its own balance sheet. This is the e-money issuer, which is distinct from the bank here. E-money issuer, on the liability side, it'll have individual deposit accounts just like a bank will. So I can come in here, the same way as I can go to the bank and deposit a little bit of money to my account, I can come in here with a little bit of money and deposit it into my own little account. This is money that the issuer owes me personally. The difference between the e-money issuer and the bank is not on the liability side, it's actually on the asset side, because the issuer is not now authorized to issue loans to just about anyone. Instead, there's only one thing they can do with this money, which is deposit it into a bank account through a pooled bank account. This is money that they can only push into one or more bank accounts. Let's say it's just the one. So what you see here, that what the bank now can, with the money that it just took in from the e-money issuer in this single one big large account here, it can now issue a bunch of loans. What you can see here is that the business of the e-money issuer really is just individualizing this large one bank account. Because from the point of view of the bank, it looks like one bank account which is owned by the e-money issuer, but then the e-money issuer turns around and itemizes that across many individual customers. This account here that I hold is not a bank account because it's legally money that is owed to me by this e-money issuer, but it's like a bank account in the sense that what's backing my deposit is money that is sitting in a bank account. So is this a safe activity? Or in particular, what must the regulator insist on in order to make sure that this is a safe scheme? The first thing the regulators will want to insist on is that there's adequate regulation and supervision of operational and technology risks. And there's basically two risks here that need to be taken into account. First, when a depositor comes with cash at an authorized outlet of the issuer, does this money then get reflected in the bank account of the depositor? Typically, money issuers do this accounting in real time, which is why they'll issue cards or mobile based infrastructure to make sure that the moment cash is handed in by the depositor, that their account is reflected electronically immediately. The second operational risk that needs to be taken into account is making sure that the sum of all the individual accounts is equal at all times to the size of the pooled bank accounts, so that if there's more money coming into the system, that this money is transferred over in real time into the bank account. These are operational technology risks because they're very straightforward conceptually. These are binary risks. Did the account get updated immediately when the deposit came in? Yes or no? Is the sum of individual deposit accounts equal to the sum of pooled bank accounts? Yes or no? It's a technology risk because this is typically all done in real time through a technology platform, and it's an operational risk because there's procedures that need to be handled for reconciliation, for exceptions, and so on. These are fairly straightforward stuff that can be managed through checklists and simple tests. The other part of banking risk that regulators don't need to worry about in the case of e-money issuance is prudential risk. And in a sense, this is the much bigger deal risk of banking. This is the risk that once the deposits have been taken in, is that money being loaned out responsibly? Is it being given out to people who are going to be repaying the money? This is the prudential risk, and it's much tougher to deal with because unlike 1 and 2, which are either it happens or it doesn't happen, 3 is a judgment call. It entails making judgment on those borrowers on whether they are likely to repay or not. This then is what calls forth a very heavy interventionist regulatory regime and supervisory regime to make sure that the banks are exercising good judgment at all times. It's not just about checking their technology platform and procedures. They need to be making sure that the good practices are being followed when they're authorizing loans. In the case of e-money issuer, prudential risks don't arise because they don't loan out money. All they do is pass money on to fully licensed bank. It's not that prudential risks don't arise, but rather what's happening is that the prudential risks are being passed on or outsourced to the bank, and that's what the pooled bank account does. By passing this money on to the bank through the pooled bank account, now it's the bank's business to invest that money responsibly. But of course, what you've done now is passed on the prudential risk to players who are already regulated and supervised to handle that risk. And the third aspect regulators need to worry about is the principle of separation between the e-money issuer as an e-money issuer and the operating company that is behind it. So here we can put the operating company, which might be PayPal as a company, or maybe the mobile operator. And it's in its asset side, the mobile operator will invest money in loads and loads of antennas as they cover the country. It will have all sorts of IT platforms to support their core airtime business. What we need to make sure from a regulatory point of view is that this money that is raised from the public does not go to fund the operator's core activities, because it should all go into this pooled bank account. With separation, then we can envision a situation where the operator fails, and it's not a problem for depositors of the e-money issuer, because none of the money that they need to get back depends on getting money back from the operator, because all their money is backed by a bank account. Separation, therefore, entails also that if the operator fails, the creditors of the operator cannot access this pooled bank accounts because it's not their money, it's not the operator's money, it's the money held in trust collectively for the individual depositors of the scheme. If we preserve, if we put in place a regulatory and supervisory framework along these principles, then we are close to instituting through the e-money issuer a fail-proof bank. Fail-proof in the sense that it's very difficult for this system to go under because it's such a simple operation. It takes, the moment it takes money from a depositor, it puts money into a bank account. It's not fail-proof entirely because, in fact, the bigger risks now is not so much that the issuer will go under because it's very difficult to envision how it might if operational technology risks are being addressed appropriately. But rather, the bigger risk now is that the bank goes under. If these loans that the bank gave out turn out to be bad loans and they don't come back, then if enough loans are not repaid, the bank might collapse and this deposit might go away if they're not covered by deposit insurance. So it's a fail-proof bank in the sense that it itself cannot collapse unless the bank that is backing it does collapse. Another term that is often used, it's a narrow bank. Narrow in the sense that it does the liability activities of the bank, managing all these individual accounts, but it doesn't do the asset side of the bank, which is loaning up money. This is very important because the liability side of banks is very transparent. It's very clear who is owed what money by the bank, whereas the asset side is very untransparent. You know who owes money to the bank, but you don't know what is the value of those loans. You don't know whether those borrowers are going to be repaying the bank or with what probability. So it's a judgment call. It's very untransparent. By having the e-money issuer concentrate only on the deposit side, they do the transparent bits of banking and let banks do the untransparent bits of banking. It's a narrow form of banking. To put it in different terms, the e-money issuer handles the utility aspects of banking, which are associated with their liability side. The utility aspects of banking is operating a system of accounts, letting people do deposits and withdrawals, letting people transfer money to each other by adjusting the value of their accounts accordingly. Whereas the asset side is the casino side of banking. This is about making judgments. This is about giving someone a loan and with the expectation probabilistically that it'll be repaid. By not letting the e-money issuer do the untransparent casino-like functions of banking, that's how we make sure that we can allow these non-banks to do some of banking and still have a well-functioning banking system. This is not a call for unlicensed e-money issuance. This is a call for creating a special category, a special banking financial license for e-money issuers following these regulatory principles with a much lighter touch regulation than full banks because they're not involved in the more challenging aspects of banking, which is the lending side. Banking crises have been around and will always will be. But notice the language around banking crisis. It's always about reckless lending. It's about reckless investing by the bank. The problem of banking is the asset side. Have you ever heard of reckless deposit taking? The liability side is very straightforward because that's pure accounting, which technology can do well.